It's now time for Lesson 16. As usual, I need to remind you to pause the tape and take a look at the disclaimer for every lesson. All right, today we have a very interesting and a very important topic to talk about, and that is volume. When it comes to trading, volume is really what makes the world go round. It's at the core of our activity. So it is very important to learn to understand volume and to understand how to use it in our trading and trading strategies. So we're going to begin first our discussion today by looking at how we evaluate changes in volume as they occur in the market. And then we are going to look at the relationship between volume and value area. And last, we're going to conclude our lesson with a brief discussion today of the liquidity data bank. And the liquidity data bank, from the name, anytime you hear the word liquidity, really in the market, it's another synonym for volume. Volume creates liquidity. Without volume, you certainly have no liquidity. So anytime someone is speaking about liquidity, you should immediately be aware that they're going to be talking about volume. All right, so let's begin by how do we evaluate and how do we identify changes in volume in the market when they do occur. First of all, we need to recognize that volume is the best measure of the market's ability to facilitate trade. And what do we mean by facilitate trade? The only way prices are going to move in any particular direction is if, in fact, the auction can facilitate trade in that direction. I can't continue to move higher without buyers. So in order to facilitate the trade in an up direction, I have to have buyers. And similarly, the market will not continue to move lower unless, of course, there are sellers. So the presence of buyers or sellers, ergo volume, is what really facilitates trade in the market. And volume is the primary indicator for determining this directional conviction, whether the buyers will continue to buy or whether the sellers will continue to sell. And this is how we determine directional conviction, by the level and the extent of volume activity that we see in the market. Now, when we talk about the power of volume, we need to understand a couple of things. First of all, the greater the volume of transactions, the better the market is facilitating trade. So the more volume that we see, the better facilitation. So when it comes to volume, more is better. Now, if a directional price movement does not generate volume, what's going to happen in the auction? The move simply will not continue. So rule number one when it comes to volume, for a continuation of a move, you need more volume. If the volume starts drying up, the move that you are looking at is coming to an end and is going to conclude unless someone comes in with volume to help that move. I like to think of it this way. Volume is the fuel that powers the move. If you hold back the fuel, the move is not going anywhere. So always remember, when it comes to volume, more in the same direction is definitely better. More volume is a sign of continuity for the move. Volume drying up signals that the move also is about to conclude. Okay, so now we get to changes in volume. How do we, in fact, look at the market and identify changes in the volume? We've already established the rules that we've just discussed. Now we want to look at actual changes and how we identify them. And the way that we do that is we have to measure volume. We can't really monitor volume in a vacuum. We have to have something to look at. And so what do? We create what's known as a baseline. You have to have a baseline for the instrument that you're looking at. When you have a baseline for the average volume, then you begin to develop a feel for whether the volume is increasing or decreasing, whether this is high volume or low volume. So this, of course, is going to vary significantly from one instrument to the next, and consequently, this is an area that requires a little bit of work on the part of the trader. And consequently, this is also an area where a lot of traders fall flat because they're not willing to do the work. And if you don't do the work, you won't have the information. And believe it or not, there's no platform out there that will give you the kind of information I'm now going to tell you you need to have and you have to have at your fingertips. It's what we call primary market data, data that you have to extract from the market itself. What we're going to do is to begin to sort of look at the data that we extract, and we're going to do comparisons. We have to look at past figures and compare them to current figures when it comes to volume. Without this data, we're really dead in the water. It is very difficult for us to make any kind of an intelligent decision about changes in volume. I'm going to give you an example here to demonstrate and illustrate the point that I'm trying to make. Take a look at this day. And we're looking at our footprint chart, and we're looking at the very first 5 minutes, and this is for Tuesday, February 2nd. And if you take a look, the first 5 minutes, I had 77,538 contracts traded in the first 5 minutes. Okay, is this a high volume? Is this a low volume? If I have no historical data, how can I ever answer this question? In the first 5 minutes, right away, I can extract a lot of information from the market if, in fact, I have the data that can support my decision making. So 77,538. That could be modest, that could be high, or that could even, for that matter, be low. If you've been trading the ES minis for a while, you should recognize that that is a fairly high number. But really, there's no way to do that without looking at other numbers. So let's take a look at some other days. This is data from the prior week, the same time period. And of course, when you compare, you have to compare apples and apples. So I'm beginning by looking at the first 5 minutes of trading. In this case, we had 45,000 traded contracts in the first 5 minutes. So you can see that at least in comparison, this day was lower. But is 77,000 sort of incredibly high? How high is high? You will never be able to develop an appreciation for the comparison without having the data. Let's look at another day. Same week, but this is from the prior week. We had 48,404 contracts in the first 5 minutes. So once again, this is telling me that perhaps 77,000 may be a high number. All right, another day from the same exact week. And take a look now, 16,579 traded contracts. All right, so obviously this is a lower number. So you can see that the numbers fluctuate quite a bit even within the same week. And the only way that you are able to make intelligent decisions about these numbers is if you have created what we call a data bank. And so you need to work on developing your own data bank for the first 5 minutes, for the first 10 minutes, and for the first 30 minutes, because the early part of the day, and for the first hour for that matter, is a very important segment of the day, as we have learned in prior lessons. So how do we do this? It really is very simple. the data is at our fingertips. And not only that, very few traders are trading with access to this data that you see before you on this chart. Right here is the total volume for every 5-minute increment. Very easy to extract that. If you want it for 10 minutes, simply add these two numbers. If you want it for 15 minutes, then you add these three numbers. You have the data at your fingertips, and be aware that very few traders actually see these numbers that you see in terms of other individual traders. Certainly professional traders are looking very carefully at this data, but certainly we are not going to compare ourselves to amateurs anymore. We are now dealing at a professional level. And so this is what professionals do. Professionals look at the numbers, look at the data, and this is where we begin to develop an idea about the structure of the market and the data that makes up the market, and then it really helps our trading decisions. So begin to create your own table and your own, what I call it is treasure trove of market data. Now, we're not only going to look at the actual volume during the first 5 minutes or during the first 10 minutes, we're going to learn to compare from one time period to the next. So let's take a look at two things. First of all, what is going to happen the following period, but before we do that, let's also take a look at range extensions. When we take a look at the first 5 minutes of activity, and then we look at the next 5 minutes of activity, how did the range change? Because this is going to tell us a lot of information. If I look at my initial period, and it looks like prices moved up, and then all of a sudden, in the next 5 minutes, prices don't go anywhere. I don't get much of a range extension. If you notice here, this is a range extension just ever so slightly from the prior candle. Now take a look here. We extend on the next candle a little bit lower, but we don't move any higher. So this already tells me something about the market. Two things. One, the market in terms of volume is tending to push lower. But at the same time, I need to be cognizant that it is not pushing very hard towards the lower end of prices. And the way that I can discern that is because even as the sellers are coming in to sell, the buyers are still lifting the bid up towards the ask, and I'm not getting a lot of trade facilitating trade in the lower end of the ranges. So it is very important to look at volume and to look at what is happening to range extensions and which direction are the range extensions going in. So you don't just look at numbers, you have to be able to identify and understand what these numbers mean. Now we also need to look at the profile as it's developing and learn to associate the volume developments with the actual profile development itself. Now, each of these, as everyone knows by now, each of these letters is a half-hour increment, and by the end of that half hour, you should have a very good idea about the flow of volume, how volume flowed during that first half hour. And this will give you tremendous insights in understanding what is likely to happen in the next half hour. So you look at the rotational factor, you look at the volume flow, and you will find that now you are in a much better position to make intelligent decisions come the next period. You will also be able to identify very early on in the day the type of day development that you're going to see. You will be able to identify non-trend days by virtue of the volume activity and the extent of volume and the direction of range extensions. So this is really the core of the building blocks of the profile. It does involve a little bit of work, and it does involve collecting data, but it also gives you a tremendous edge in the market. Very, very few individual traders, first of all, have this level of information. 2, know what to do with it. 3, even have collected it. So just imagine now how much further ahead you're going to be of the crowds when you have this kind of data. All right, let's take another look at another day, just to emphasize what we are saying. Take a look at what's happening during the first 5-minute periods. We get a tiny little range extension to the top. So it doesn't really give us a lot of strong convictional direction. It's a very minor range extension, and there's no apparent direction yet. So I don't rush in and take a long, as many people do. Wow, we're moving up. I did get a range extension, but you have to look at the extent of the range extension and the volume that accompanied that range extension. How much volume did it take to give us this range extension? Should I have expected more or less? And these things, you develop a feel for them, but you definitely have to be looking at your charts and collecting the data to do that. All right, now this ends up being an always with every day. As you collect the data for that day, at the end of the day, you want to attach a picture of the day in terms of how it developed, because this will really help you visually see how things come together in the market, and you will be able to spot instantly changes in volume as they begin to occur and anticipate what their impact is going to be on prices. This is why this is a very powerful tool that you need to learn to use in your trading, and will significantly help aid your decision making and your ability to identify potential opportunities early on as they develop. Now, let's take another look at an example here. First of all, when you see low volume like this, it should clearly indicate to you that there is no apparent direction in the market yet. At minimum, you should be able to identify now right away whether the other time frame trader is participating in the market or not. And when you begin to see this level of activity, it should immediately indicate to you the other time frame trader is not in the house. They haven't shown up yet. They're late for work today. So notice now, as soon as they step in, you can tell, you can see that, they're now in the house and things are going to move. And sure enough, when you now, normally you wouldn't see all this activity that follows, but take a look, because of this very low volume, how prices stayed in a very narrow and tight range. And fortunately, we already know if in fact prices are going to trade sideways, well, we know what type of a strategy we want to use for that kind of a market as well. So at least it gives you an indication about what is happening and how things are developing in the market. And this should not be, the importance of this should never be underestimated. All right, now notice, even though this day started out looking like this, and it was a sideways movement during the early part of the day, this actually ended up being a directional day. Take a look at this, and that's why you'll, during the day, be able to spot, and sure enough, they came in D period and extended the range. With the data at your fingertips, you will be able to spot when they come in and when the directional move begins. And this is one of the best ways that I know to be able to get in on a trend quickly, by looking at the volume figures. All the other elements on the chart can be deceiving and are not as concrete as looking at volume. All right, now here's another day, and we're going to look back at the day when we had a very large number right at the open. 77,538 traded contracts in 5 minutes. Okay, and what happened? Prices dropped. The amateur now would rush in and say, 77,000 and we're heading down. This is a trend day. I'm going to short the market. amateur again because you really didn't give the market time to develop. You have to be very careful trying to trade moves very early or very quickly in the market. Because take a look at what happens on the following candle. All right, what happens is we get 60,000 in terms of volume. But more importantly, what happens to the range extension? If in fact we were going down and you saw 60,000 contracts in volume after 77,000 and the trend is lower, wouldn't you expect that the range extension would be a little bit more than just 1, 2, 3, 4 ticks? Yes, I would. And by virtue of the fact that I only had 4 ticks down, yet my range extension was to the upside, and I exceeded half of this candle that it took 77,000 contracts to bring down to this level. Now with 60,000, I was able to actually move up to almost near the open of that candle. What does that tell me just looking at volume? It tells me there is a buyer in the market that has stepped in and has lifted the bid prices up, that this is buying pressure coming into the market. Now, what would have happened to me if in fact I had taken a short? I would have to exit at a loss at this point. Now, notice what the market makers do. Because this is such an obvious bullish signal, and it is also one of those recognized candlestick patterns, the buyers will pull back. Even though they are going to push prices higher, they will pull back to give the illusion that in fact the market is going to go lower. And if we go strictly by candlestick patterns, and this is why candlestick patterns are very deceiving at times and do not work effectively. This is a pattern that's known as a green candle ignored. You have red and you have another red. Some people will also call this the sandwich because you have red on both sides and then they will begin to short here. These patterns, the market makers are incredibly adept at creating these patterns for you when they know very well that's not what's going to happen in the market. That's just an easy way to trap traders. So don't go by these sandwiches, and you have a far more powerful tool. You're looking at volume and range extension. Focus on what matters, not these silly things that you will hear so many people talk about. They talk about them because they don't know any better. They don't have the level of data or knowledge that you have. So now you need to focus. Well, let's take a look at what actually happened vis-a-vis volume. Look at what they did. All of a sudden, they pulled back a little bit in terms of volume. So when they pull back a little bit, it wasn't a very big pullback, it's a small pullback, but they pulled back about 20,000 contracts. So they gave the sellers just a chance to come in and take over a little bit. And what happens, we still are not able to get a range extension even less than the half of this bar. We weren't able to make it even lower than that. Now, is that really selling pressure? Is that really a market that's dropping? Absolutely not. The range extension, again, is still to the upside of this, and the market is not facilitating trade to the lower side of the candle. Another thing you can quickly look at, the volume on the low end versus the volume at the high end of the candle. Look at the last two prices up and the last two prices lower. When you see that the prices are at the top have significantly higher volume, this is another indication to you that the market is facilitating trade to the upside. The auction wants to move up. Remember our two key questions. Where does the market want to go? Where's the attempted direction? And how well is it doing it? Well, the market wants to go up. We've established that. How well is it doing it? It's being sneaky right now. It's pretending like it doesn't want to do it well, but it really is doing it rather well when you see what's happening behind the scenes. Now take a look. after they created the sandwich for everyone to take a bite, they then come in and push prices higher because they know that so many others have bitten into the sandwich. And now when they come up with prices, what happens is all the stops that were placed right here at this point have just been taken out. And it gives them a little bit more food for their lunch money at the end of the day. So learn to understand the dynamics of the market. Follow what's real, and volume, you can't get more real than volume. Volume counts. All right, and take a look at this day that we were just looking at. It was quite a directional day, and look at the day that started out with that big red candle eventually ended up looking like this. Now, I don't want you to think for an instant that the market makers didn't know, or these buyers didn't know what was going to happen. They knew. This was all very deliberate, and this is unfortunately how a lot of traders get suckered in the market and get taken into the wrong direction. All right. Now we're going to switch gears a little bit and not talk so much about changes in volume and range extensions and how that gives us insight into what is happening in the market. We're now going to look at volume vis-a-vis the value area. So we're going to look at a slightly different type of chart, and we want to know what is happening to the value area as volume increases or decreases to give us insight as how a move is likely to continue or not. And let's begin by talking about value area placement, what value area placement is, and what it does for us. First of all, value area placement really tells us where one period's value area is in comparison to the prior period's value area. And it helps us answer the question, how good a job is the market doing in facilitating trade in the direction of a move? So we say then that value area placement helps us evaluate directional performance. So we've established, or now we know that we can identify where the market wants to go, and to be able to answer the next question, how well is the market doing this, we need to begin to take a look at volume and value area placement. And let's take a look at how we actually do this. First of all, you need to understand that there are 4 different basic value relationships that you will see to volume, or value placement relative to volume. Value areas may actually take a clear position higher or lower than the prior period's value area. We could have value overlap to one side or the other. And we can have value area contained entirely within the prior period's value area. Or we can have a value area encompass the prior period's value area. And the best thing to do is really to illustrate and demonstrate these examples so you can visually see what we're looking for and what we're looking at. All right. This diagram is really a simple value area. So what you're looking at, this is the value area here. This would be the value area low, and this is my value area high. Now, whenever you see the value area moving higher, as you see here, notice the value area is completely above the prior value area. So when we compare this one to this one, look at what happened. It went up. The value area moved up. This is telling us very strong directional conviction in the market. The greater this gap between them, the greater this conviction. So when the market is trying to move higher and we see 2 consecutive value areas moving higher, as you see here, then this is a clear indication that we have strong directional conviction in the market. All right, same thing happens if the opposite takes place. The market is trying to move lower and my value area is placed lower than the one that preceded it. So again, there's strong directional conviction, it's just in the opposite direction. Now, what happens when I get two value areas that overlap? And see here, the first question is, of course, how much overlap is there? The less overlap, the greater the directional conviction. The more overlap, the less directional conviction, that we're really still within that same value. But here, this is telling me the directional move is still heading higher, is still continuing, but not as strong as if in fact the value area had opened up here and was higher. Same thing for the reverse. If we're overlapping lower, that means that we're likely to see continuity in the market. We're still going to move in the direction, but not as strong as if the value area was significantly lower. All right, now what happens when we see this type of an action? I get one day with a rather small value area, and then the next day a huge value area that encompasses the prior value. It almost looks like it sort of magnified the value area here. Well, what this is really telling me is there's volatility and uncertainty in the market. This is, folks, the way that you begin to spot when trends are about to end. The market really is not sure of direction. Are we going up? Are we going down? It's not certain. And you begin to see market activity that really seems somewhat chaotic or doesn't make any sense. The first half of the day, we go all the way up, and then the other half of the day, prices come back down lower than where we were when we first opened. So the market doesn't seem to know which way it wants to go. Whenever you begin to see this activity, especially at the end of a move, you should quickly recognize that we are developing what is known as a topping pattern. There's going to be a directional change in the market. One of two things are going to happen. One, we're either, if we've been going up, we're going to go lower, or we're going to move sideways. But there is a definite high level of uncertainty. And as a matter of fact, if you have been in the market and tracking what's been happening in the market, as of late, we've been seeing a lot of this erratic half day one direction, and the market moving in the opposite direction in the same day, but at the other half of the day. So you're seeing this uncertainty in the market. We are really, these are the signs of a topping in the market. All right, the other possibility that we might get is what we call an inside value. And in this case, all of a sudden value shrinks, okay? And when value shrinks like that, and you look at your volume figures, volume is shrinking with it, definitely. There's uncertainty about direction in the market. It doesn't mean the move will not continue. It simply means there is uncertainty. Well, how do we determine then if the move continues in the original direction or not? Volume. When the volume comes in, we take a look at where the range extension is taking place, and that will help us identify direction. All right, now how do we trade with this valuable information? And by the way, only profile traders can trade based on this information, because no one else sees where value is. Now, if you're a swing trader, you can apply these concepts to your daily charts and use it for swing trading. If you are an intraday trader, you need to drop down to our profile of the profile, the mini profile that I showed you. So each of these profiles that you actually see on this chart represent a simple 30-minute period. So each one of them, each letter is just a 5-minute trading period. And so this is really an intraday chart, and it hasn't even finished an entire day. And let's take a look at what happens. We begin with a standard outside pattern, and then all of a sudden come D period, and take a look at what happens. Volume comes in, pushes prices higher. But before it did that, you see the outside pattern, you see the uncertainty, and you see the volatility. Now, when the volume comes in and pushes it up, already you know that we have an outside pattern, and I'm waiting to see which way it's going, the scale is going to tip, and only volume will show you that. Sure enough, the scales get tipped and volume moves significantly higher all the way up here. And you can get in on the move now. You're not afraid to take a long come D period when you see that range extension start to happen and the volume come in to support that. All right, now let's take a look at what happens next. We get a standard value area higher. It is very important to take a look at where this closed and then take a look at when this opens and begin to see how value is developing. Take a look what happened the A period, which was really the first 5 minutes of this second half-hour period. Prices came down quite a bit. So again, it may deceive many traders thinking, aha, the up move, that first half hour up is no longer here. Now is a time to take a short. And I don't know why there's so many people that are always so eager to take shorts in a very bullish market at that. The time actually may be coming for shorts, but anyway, you really need to look at what is actually happening in the market and not to have one bias one way or the other. And the point that I'm trying to make here, all that prices are doing is they're coming back and testing the high value of this prior period. And this stuff that you see here, no one else will be able to see because they simply don't have, or no one without a profile chart can see. If you have the profile, you can see it. What happens is A period drops, but we find a little bit of support. So B period opens, drops a little bit lower, and then we see that it is not even able to make it to the value high and starts moving higher. Another indication after a strong up candle like this, that this may be, if I'm out of the trade, time to take a long trade right now. And sure enough, B and C and D take us a little bit higher. As we get up here, you will see the volume dry up, and that's why the range extension started dropping lower. So even though this pattern is telling me that I'm going to get continuity, the continuity occurred as a result of the volume in this candle. Here, what is happening is I get a selling tail at the top, and now heading higher, volume is telling me is not as clear as you might think. So we have to wait and see what happens in the next period when it opens. And look at what happens now. We get an inside move. And we've already learned that when we see an inside move, what does that tell us about directional conviction? Certainly uncertainty not there. Nowhere near the same directional conviction that we saw between these two periods. Now a change is about to happen. As I begin to see A period extend and drop lower and B period drop even lower yet, I should now be able to detect that we've had a change in the market and things are going to change lower. And sure enough, take a look at the value area here relative to the value area there. It has expanded, which it has grown larger, and it started right at the bottom and continued lower, so there's strong directional conviction. I should be very comfortable with a short in this time period. The market really is telling me value is moving lower. As you can see here, much larger value area, and it will be accompanied also by greater volume. Now we begin to see a little bit of overlap between this value area and the preceding value area. The directional move is not as strong as it was. It's starting to weaken. And sure enough, take a look here. The next period, I don't get much of a drop in that period, and I start to consolidate, and the value area grows even smaller. What I'm detecting now is uncertainty there's a possibility the market may change and move back up again. So I have to wait and see what is going to happen vis-a-vis volume and the range extensions. Next period comes along, we're probably getting quite a bit of volume, but prices are not able to extend beyond the POC of this period, and take a look at what happens. The market drops even lower. So take it step by step, follow the indicators, follow the signals that volume and value area are giving you. So we begin by first all trying to identify the attempted direction of the market. We examine the volume level that is accompanying that direction, and then we try to determine the impact of volume on where value area is in one period relative to the period that preceded it. Now, I have for you in this lesson 3 tables that I hope you will you have the ability to print out and take a look at, because I won't explain every single one of them here, and really it's just a matter of looking them up, and they help you identify what is happening in the market. So if you take a look at an attempted direction, the direction is up, volume is unchanged, but the value is higher. The value area is higher. What does that tell me? Well, that there is a great likelihood of strong continuation. Look at each condition, and it helps you identify what is happening or what is likely to happen in the market. I have an attempted up direction. I'm getting lower volume. The value area is unchanged. So what is that telling me about the market? It's telling me the market is balancing and that the directional move is weakening. So there are a number of different conditions like this that I have outlined for you, and you can review them and then begin to take a look at the market and analyze for yourself, and then look up on the table, what is this really telling me? I have a down move, volume is unchanged, but the value area has moved lower. Well, this is telling you in terms of directional performance, the market move is getting weak, but it's likely to continue. And that's how you use these 3 charts that I have included for you. I hope you will find them helpful, and more importantly, I hope that you will use them and get to learn these patterns. There's a number of different permutations, but after a while it gets easy, and you're able to probably identify what is likely to happen without even looking at the table. All right. Now we are going to get into the liquidity data bank. And the liquidity data bank is kind of an interesting service, if you will, or product out there. It's only offered, it used to be the Chicago Board of Trades, but now it's the CME, and it is a subscription service. You actually have to pay money to get this. And I am not going to tell you that you need to get it, but what I am going to tell you is that you need to be aware that it's out there. You need to be aware of what kind of data it has, and a lot of the data that it has, we actually already have in Market Delta, and we can use. And I will tell you that I personally don't have it. It's certainly at your discretion should you wish to have it or not. But basically, it provides you with actual volume of trades occurring at each price, which we already have. Other non-profile traders may not have this information, but we certainly do. But here's the number 2. This is really the bonus or the key feature of the liquidity data bank. And the key feature is it will identify for you the type of trader that's participated in creating the volume. Believe it or not, this can be very valuable information. As individual traders, there are 2 handicaps that we have in terms of access to information. The first handicap that we have is even though we can see volume and we can look at the numbers and we have the data, we don't know who is creating or generating this data. That's the first handicap. And this handicap, the liquidity data bank, only for the instruments that are traded on the vis-a-vis the CME, you can get this data for. So they will identify for you who in fact is creating this volume. So they'll help you with that first handicap. But actually, the other handicap is the bigger and the more potent of the two. And that is, if you are trading in a live market, you have no access whatsoever to the full order book. And let me explain what that is and why that is such a handicap and such an advantage to the market makers. And that's why they're market makers, and they have privileges that other traders do not have. They have the privilege of being able to look at the book and see what orders are pending. So when you put an order, for instance, a limit order, and it is at a certain price, no one else in the market knows where that order is, because we're not trading at that price, and the only time that order is visible is when the market actually triggers it or you enter the market. But imagine now being able to look and see where the sellers are sitting and where the buyers are sitting ahead of when price gets to them. And quite often what we find happening is the market makers will use this information, of course, to their advantage. If, for instance, too much selling is coming into the market all at once, the market makers will keep dropping the bid lower very quickly to the levels where they see the buyers are waiting. What we have described in the past as responsive buyers. So that these buyers could come in and help them with the buying to help lift the market back up, so the market maker doesn't end up getting stuck with all this inventory from the heavy selling. How does the market know where those buyers are sitting and how far to drop the bid? Well, it's really very simple. They have access to the order book, or what is known in the business as level 3 data. They have access to that level of data that you and I never see. And so that is very powerful information. Just imagine if you were able to look at the order book right now, and let's say the market is trading at 1312, and you saw that there were buyers at 1310. There was a large institutional buyer sitting there at 1310. Well, you know that that's where the support level is going to be, and you certainly would throw quite a bit of shares or contracts short to push the prices lower to get to 1310, and then you would cover immediately once you got to 1310. Do you see the power of this information? Why it is so helpful and so valuable to have. Unfortunately, though, whether you recognize its power or not, we do not have access to it, and we have to learn to trade without it. So now you know the two handicaps. You don't know who is behind the volume, and two, you cannot see the order book or the orders that are on the order book. Well, who in fact is on the order book is broken up into 4 different categories by the exchange, so they don't actually give you the names of the individuals or the entities. They simply break them up into 4 different categories. And as a matter of fact, they label these categories as C1, C2, C3, C4, meaning category 1, category 2, category 3, and so on. Now, the first category is your local floor traders. So you will be able to see how much of that volume is the local. And the local, again, is the individual that is responsible for the two-sided trade, the traders that actually create the value areas, that love to trade around fair price, because they're going in and out frequently for very small gains in the market. These are the locals. Then they have what they call the commercial clearing members. So you'll be able to identify how many were commercial traders, or how much volume was brought in by commercial traders. This is really the big boys. The commercial traders are the institutional buyers or sellers. And this is the information that everyone is trying to find out and to see. So if you subscribe to the Liquidity Data Bank, you will in fact be able to get this information, and you can get it live during the day, or you can get it at the end of the day. There are two different prices, I believe, for that. Now, you also will see two other categories. Exchange members filling orders for other members. And again, this is a different level of commercial activity. Or you will see the brokers, members filling orders for the public. And so you will also get to see the transactions that are conducted by the public, what percentage of the volume they constitute, whether they're buying, whether they're selling, and so on. So it's certainly nice information to have. The key question is it worth the money to you? Do you do the level of trading that would warrant the additional overhead cost of acquiring and getting this data? And naturally, this is a individual and a personal decision. All right. The other thing that I want to point out to you is the Liquidity Data Bank looks at a completely different value area from the traditional value area that is identified for us by the profile. They actually do not use the TPOs, the time price opportunities, so they're not looking at a profile based on price. They're looking at a profile strictly based on volume. The nice thing is we have the ability to do the same thing. So take a look, for instance, at this trading day with me, and take a look at the volume area, the volume value area, rather than the volume. And you can see here low volume and the high volume level, and we have 292 above this point of control based on the volume, and 2 million below it. So this is a very imbalanced market. Now, if you take a look in comparison, here's where the price value area is, and this is the one more common. This is the one that is in fact used on the profile chart. It's based on the counting of the TPOs, but this number here, or this value area here, is not based on TPO counts. It's based on actual traded volume. There's a lot of debate that goes back and forth about which of the two is the more important, and I would say to you, they're both important, and you need to keep an eye on both of them. And you will find usually that the volume value area will be more indicative of what is likely to happen in the market, simply because volume moves the market and not price. So volume will initiate the activity, and then shortly thereafter you will see price follow suit very, very quickly. So if we were to take a look at this particular volume value area, we are very heavy to the downside below here. So what often happens when you get very strong directional days like this is we get a little bit of continuity, but then the market starts to seek balance, and then we begin to see the market tilt in the other direction a little bit. All right. Another simple yet powerful volume analytical tool that I want to leave you with. It's very quick and very easy to do, so I encourage you to always do it, except when you do it, don't do it on very short time frames, or you need to be looking at a half hour at minimum. What you're going to be looking at is what we call the top 5 and the bottom 5 calculation. And what we're doing here with this calculation conceptually is very simple. We take a look at the percentage of volume that's traded at the top 5 price levels in the range. So this has been my range for, say, an hour. And I look at this range at the top, and then we're also going to look at the bottom. And then I tabulate, or I calculate, add up the top 5. And if you look at the percentages, 0.3, 2.3, 5.8, 6.2, 7.4, that's 22%. That's the total for the top 5. Now, what I'm going to do now is I'm going to drop down and do the same exact thing for the bottom 5. And once I come up with the two totals, I compare them. And in this simple comparison, I ask myself one very easy question. Where is the market facilitating trade? Is it facilitating it towards the top side of the range, or is it facilitating it to the lower end of the range? And if you look at these two numbers, it really is not difficult at all to see the answer. Obviously, the market is facilitating trade towards the top of the range. So now I try to answer the other important question that we always ask: which way does the market want to go? Well, obviously, based on the data that we have right now, volume wants to move up. So if in fact I start to see some activity in the market and volume comes in and I get a little bit of a range extension to the upside, do I feel comfortable taking along or not? I should, because the market is telling me it's facilitating or giving me one additional piece of clue or one additional piece of information that is where trade is being facilitated. A lot of individuals do this calculation at the end of the day to try to see and anticipate what is likely to happen the following day. It certainly you should not rely on it in itself as sort of the pivotal decision-making element of your trade decision, but it is another helpful or simple, quick tool that gives us useful information. And so we combine that with, again, looking at volume, looking at value area, looking at the rotation factor, and then you're going to develop what I've referred to in the past as a preponderance of evidence. So in many ways, you're working like a detective, or back again to that analogy of the puzzle. You're trying to put together different pieces of the puzzle as you go along, and the more you add, the more pieces you add, hopefully the clearer the picture becomes, and the more you are able to see what is happening in the market, and this allows you to make better decisions and allows you to trade in harmony with the market. By the same token, it also allows you to detect when you've made an error in judgment, and sometimes we will all make errors. It is very important then, if I see data that isn't supporting my hypothesis or theory about what is likely to happen, that I should also take note of that and exit a trade. So all this information works in two ways. One way to help you identify opportunities, and the other way is, of course, to help you exit and get out of opportunities that you certainly don't want to be in. But this helps you gain a glimpse of, and some of this, some of these calculations are also part of what the Liquidity Data Bank may already do and offer for you. They give you lots and lots of numbers. So I don't know if they offer a trial service. They may even have a trial service. If they do, if for no other reason, just to become familiar with what this product is, I would encourage you to perhaps try their service for a month or so. Just go to the CME website, and they will let you sign on.